Okay, so now that we've got the assumptions placed down below, doing the mechanics is fairly trivial. So we're going to simply grow the revenue by the growth rate. We're going to, and here, by the way, I should say before we dive in, there's sort of a decision to make. How do you calculate cost of sales? Here we're saying we're going to want this to be mechanically a plug, which is usually the right move, and basically that means gross profit. We just hard code we just directly, I should say, calculate gross profit margin by the revenue, and therefore, since we know that revenue minus cost of sales equals gross profit, we can just back into what this number is and switch the sign, or just keep it simple and just do this. Now we can, fill that across to the right, and if the fact that this isn't formatted right away bothers you, I usually do it at the very end, so I don't have to keep hitting reformatting, but just so you see what's going on here, just to make this easier, we've got the revenue forecast followed by the cost of sales. The other way to do this would have obviously been to do a little bit more like complicated mechanics, which is to calculate cost of sales. Cost of sales as 1 minus the gross profit margin, multiply that by the revenue, also make sure we put a minus sign there, and that would have gotten the job done. And then the only advantage of doing it that way, of sort of directly arriving at this, is then I could actually keep copying, and I could just use the gross profit formula that I had historically and fill that through across to the right. And then I retain the fact that the subtotal is the same that's before. There's some benefits to doing it that way. It reduces the likelihood of a mistake where you inadvertently copy and paste this across because it's a subtotal. We ultimately chose to do it the other way because it's just more direct and easier to kind of think through. But I did want you to understand that's another possibility and something you're going to see in models quite a bit. So let me sort of bring this back to what it was, where cost of sales is essentially a plug and this is a subtotal. Okay, so I think we're in good shape there. The next step is research and development. This becomes fairly straightforward. 6.2% times, you take the driver, the assumption I should say, multiply it by the revenue. Same with SG&A. And now this subtotal, I can actually copy and paste this across. And now I can just really fill this, because this, again, I'm not directly forecasting this. Fill this to the right. Control-Shift-1 if you've got Macabacus. Otherwise, you hit Control-1 and format it the way you want. Make sure that this is bold. I skip these two lines. Other expense, straight line, right? And so one of the things here, so this is something that we haven't really explicitly talked about. Well, what is that other expense? What's the nature of it? What we do see is that it seems to be consistently an expense. Sometimes these line items that Apple doesn't necessarily identify, or the company presents their financials, they don't explain exactly what it is. And just as a reminder, this was, when Apple reported, if we go into Apple's 10K and we looked for sort of other income and expense, we saw this breakout of sort of interest income, right? So Apple has a ton of cash on its balance sheet, so they're generating $5 billion of interest income, then another $3 billion, or I should say rather a $3 billion expense. That's consistent, and we're going to look at schedules to really forecast this, because this is why we can't forecast this yet, right? This is going to be a function of, what is the cash forecast this company is going to have? A lot of work has to go into that to get to that, and it really is the plug in the model that really wraps everything up. Same with interest expense. But what is this other thing? You're always going to encounter on the income statement something called other. Companies don't necessarily tell you what this is. This could be some catch-all bucket of non-operating expenses or income potentially. And when they don't exactly tell you what it is, you kind of look for trends. And what you see is that it's consistently an expense, but it's pretty wacky. It can be up, it can be down. And so you really have two choices there. One, as a best practice, is you look at the last several years, or you just take the last year and you straight line, and that's what we've decided to do here. Now, we're going to be able to subtotal this. It's the same as it was historically. So you look at the historical formula. You could just paste that across. It's very important that you get this forecasting, that you get the formulas right here. You don't have a plus or a minus sign that shouldn't be there. Like, if you just typed in, if if you switch the sign anywhere here, like I just did, notice by the way, I forgot to switch the signs here. That would have created a lot of problems for me down the road if I didn't notice that. Expenses need to be negative, right? Same with taxes. I have the tax rate, 16.7%, multiplied by the pre-tax profit. I need to switch the sign, right? Make sure that's negative because expenses are as negative. This is our sign convention that we have to stay consistent with. If we made the decision to keep signs negative, they got to stay negative the whole time. You saw how easy it is for even me to forget this stuff, and it's a big cause of problems down the road. So now we're able to switch the sign. One other thing on taxes, make sure that you're always defining tax as a function of the pre-tax income as opposed to anything else as a function of revenues. Common mistake. People are kind of going through this mindlessly and calculating taxes as a function of revenue. It's a function of the pre-tax income. So we're going to paste that across. And then last but not least, the subtotaling works in on paste specialing formulas. That's what you're seeing there, so that you don't. I want my model to still have this formatting so it looks exactly like the model you should be working on. Depreciation I have to skip because that's going to come from a schedule. I have to figure out what my property, plant, and equipment balances are, what my capital expenditure is going to be on a forecast basis. So a little bit more work to do on that one. EBITDA, I could just copy and paste this. It's just D&A plus EBIT. I don't have D&A going forward, but I will, so I can create a placeholder formula. Right? Let me bold that. So, right, this number isn't quite right yet because I'm missing some stuff. But as soon as I get D&A, I'll be able to calculate EBITDA. Now, last but not least, stock-based compensation. Stock-based compensation, as we talked about before, refers to a bunch of expenses that are really accounting expenses. When Apple issues restricted stock or other companies issue stock options, depending on who they're giving it to employees, whether the employees are accounted for their labor under cost of sales, or whether they're sales and marketing folks, or whether they're in Apple's case, software engineers, they all get stock options or restricted stock. The company has to recognize under accounting rules expense, even though it's a non-cash expense, because there's obviously value in giving those options in terms of they're going to become dilutive securities down the road. There is a process for determining the value. Usually it's a binomial pricing model or some sort of option pricing or some sort of pricing model to figure out the value of these things. And what we're basically saying with this forecast, which is let's grow stock-based compensation in line with revenue growth, what we're saying is, look, as the business grows, we don't know exactly how much restricted stock and stock options this company is going to issue down the road. What we do know is historically, they recognize about $5 billion in the last couple of years, at least $5 billion worth of expense, non-cash accounting expense due to the value given with restricted stock. Well, let's just assume that as the business grows, so will this value. And again, this is kind of a high level assumption, but it is the best practice. It's what you see in just about any model, because you never have the information, or I should say almost never have information to get deeper into what this forecast might look like. So it's almost always driven by a revenue forecast. And with that, we have finished the core model, the core income statement, I should say. Obviously, a lot of things still have to happen for us to wrap this up, but the core income statement, and most importantly, the forecast, the assumptions, the drivers of this model are now in place. As we turn to the balance sheet, you're going to find that so much of what's happening on the balance sheet is very much driven by this. These assumptions that we're piggybacking on JP Morgan from are not only driving the income statement, but they will indirectly now start driving all the things on the balance sheet down below. Okay, so in the next video, we're going to turn to the balance sheet. The one thing that I always like to do at this point is, even though a lot of stuff down below here is going to change, we can already get a sense. I just want to always sanity check my work. I'm basically saying that I think Apple is going to do $61 billion in EBIT in the next year, which is really a decline from last year. Right? So last year they had this big bump. And so any sort of thing like that where a company is moving away from what you typically expect, which is sort of growth, you always want to make sure you didn't screw something up. And so what I'm going to do now is I'm going to go back to the JP Morgan research report, and I'm going to look at what they're actually saying. Right? It should be pretty much the same thing because I've used JP Morgan to come up with this estimate. So this is operating income. Okay, this is what they've got here for operating income. And they've got it going from the last actual of 70.898 billion, which is what I have, And then they've got it going up to 61,615. We'll chalk that up to rounding, but we are exactly where JP Morgan, almost exactly where JP Morgan is, 61, 67, 72. And you see that that's exactly what's happening here. And that gives us comfort that we at least didn't screw something up. We are at least modeling this after what we were attempting to do, which is to model this after the forecast that JP Morgan was making. And then going forward, these are really our own forecasts, but they are just a continuation of JP Morgan's last actual year. I'm going to do one final sanity check, which is always something important when you're working with a public company, and that is to go to the consensus. The consensus forecast, which I've given you this file as well, comes from Capital IQ and says, okay, well, is there consensus for EBIT? Because that kind of tells you how far, as EBITDA we don't have yet because we can't quite add back D&A, but certainly for revenue, I can look at what the sort of consensus is. If you add up all the JP Morgans of the world, right, the Morgan Stanleys, like all the analysts that are submitting, all the sell side analysts that are submitting their forecasts, what does that look like? So revenue is going from, going from the last actual 265, then it goes down to 257, back up to 283. Well, we're pretty close, right? So maybe JP Morgan's a little bit more bearish in the first year, but then it gets more aggressive in the third year. And if you look at all the way down to EBIT, and by the way, this is about 37 analysts submitting these forecasts. It usually gets pretty thin after 2 years, and now only 13 analysts, JP Morgan presumably one of them because we have their forecast, submitted to Capital IQ a forecast for 2021, and then it gets really thin. And so but that's the reality of sell-side research, is really focused on those first 2 years. Just the nature of the focus of the buy-side community tends to be on those, the upcoming quarters as opposed to a long-term forecast like a lot of investment banking models are. And so we have that, and then we look at EBIT, and we see that EBIT is generally in line, 62, 65, 69, 60, almost 62, a little higher, 67, 79. So we're a little higher towards the out year. JP Morgan was an overweight, and they seem to have forecasts that are a little more aggressive than if you kind of average everyone's forecast. But we are very much in the ballpark, and we feel very comfortable that this represents, at least so far, a street case model, which again, we will sensitize down the road. So at this point, in the next video, we begin talking about forecasting the balance sheet.